If they continue that, inflation is going to rage, and it's already more than 2 times their stated policy level. So the Fed has to not continue its easy money policies too much, or you could talk about runaway inflation, and they don't want that. It's dangerous to them.
This week's special with Miles Franklin Precious Metal Investments. 1 ounce silver Krugerrands for only $3.95 over spot. Call us at 1-888-81-LIBERTY. That's 1-888-815-4237. Hey everyone, this is Elijah K. Johnson with Liberty and Finance. And back with us today is Robert Kientz from Gold Silver Pros. Robert, thank you so much for joining us today.
Elijah, thank you so much for having me back on. It's been a pleasure.
It's great to have you. And what I first wanted to discuss is the markets today. We're seeing both gold and silver fall. That may be because of the news that the Fed will most likely taper. Once this is posted, our viewers will know if they did, but most likely it's looking like they're going to taper today. And we're recording this on November 3rd.
Yeah, in about 45 minutes at, I believe, 1 p.m. Central Time, 2 p.m. Eastern Time, the Fed's expected to announce taper. Article in Reuters today suggests that it may be about $15 billion per month as they slowly taper their $120 billion a month bond buying program or asset purchase program, and that they see some of the issues as being resolved. As I'm looking at the article and some of the news, the Fed has seen a slower than expected reduction in inflation. Inflation's running about twice their target, so they're worried about that. And so I think they're going to slowly taper and maybe not reduce that program faster as they deal with the inflation issue. It seems as though the employment as well has been a little bit slower to recover than they expect. The employment report from ADP today, which is a preview of the big employment report, the non-farm payrolls that comes out Friday, the first Friday of every month, it turned out better than expected. 571,000 jobs added, according to ADP, most of those beating the 395,000 Dow Jones estimate. Most of those added in leisure and hospitality, so we're seeing a recovery of the hotels and the restaurants and that sector with 185,000 new positions. Large businesses had the majority of the 571,000, adding 458,000, so definitely positive news there. But in the Reuters article, it does point out that the recovery in employment is slower than anticipated. So the Fed's going to be watching that to see if that recovery continues to increase more broad-based across the rest of the economy and not just in leisure and not just in the large corporate sector. They want to see that increase across the different sectors as well. Still some concerns there about all of that. High inflation, not quite a big recovery in jobs as expected. So the substantial further progress that the Fed wanted may not have completely arrived yet. So it'll be interesting to see whether they follow through on reducing, those bond asset purchases by $15 billion a month like people expect and like the market, I think, is pricing in. We'll have to see. I do think, going back to your original question, that is affecting gold and silver price. We saw a sharp sell-off this morning in both gold and silver. And it looks like it's down about 1.5% each, about 1.4% in gold right now, 1.51% in silver, which is not a huge sell-off. And that does seem to coincide with the jobs report being positive today from ADP and the expectation of the Fed taper of the bond asset purchasing program. So I don't know if gold and silver will continue to sell off throughout the day or if it'll stay about where it is. But that looks pretty reasonable given the news that we have coming out this week.
Now, with respect to how the stock market is reacting, we're only seeing the Dow at the moment down 0.36%. So your perspective on why precious metals fell quite a bit, but the stock market is not really reacting much.
So interesting thing about the stock market is, and a good friend of mine who is a financial expert, Chris Galizio, who we're working on a movie together called The Money Game to explain this phenomenon that we have now. The stock markets aren't reacting like you normally would see. About every 4 to 10 years, you get a healthy correction. We haven't had one basically since 2008, 2009. So we're a little bit long in the tooth in terms of this cycle. And the stocks keep going up past what historical norms should say. For example, the price to earnings ratio of these stocks is really inflated. You have companies like Tesla that has finally started earning money, $2 billion year over year in cash earned and net income, but they're trading over $1 trillion for the first time. Tesla hit over $1 trillion, I believe it was last week. So Why would a company trade $1 trillion when it's only making $2 billion in the last year? So you see these overvaluations, to cash flow and to price to earnings ratios of the stock market. And what's essentially happening is, in an era where we have real negative interest rates, meaning the inflation number minus the stated interest rate is negative, leads to a negative rate on money, essentially. When you have a negative rate on money, it's basically very cheap to borrow money. And when you're in that environment, very cheap to borrow money, you can inflate your company very easily simply by taking on debt. There's not a whole lot of risk there because your bond payments are very low. And it's what companies see as a favorable way to positively take on cash to expand operations. In fact, in the United States, I think as of last quarter, we had $180 million of negative yielding corporate debt. So negative interest rates have come to America. So when you have free or even free money or money that people even pay you to borrow from them, like in a negative interest rate environment, it makes it very easy to expand operations. How long this can last, however, how long the American public will accept negative real interest rates and negative yielding corporate bonds, I don't know. I don't think it can go on forever. But that's what causes these companies to expand beyond what we would see in normal times, because we're having, a very permissive borrowing environment, and the Fed has been very permissive in creating, new money as well. It'd be interesting to see, Elijah, today. They also industry experts expect not only to them announce tapering, but a rate increase in 2022 on the Fed funds rate. Now, if they do that, that could be a bigger overall impact to the market. It would be somewhat unexpected, and it would mean that some of the easy money policies are starting to ease as well. If the Fed starts really raising interest rates, that really changes the picture of how the stock market is valued. In terms of gold and silver, I think it's reactionary. The sell-off, I think long term, still bullish on gold and silver. But again, that's why you see a difference between the stock market, which seems to be behaving irrationally, and what's happening in gold and silver.
And it seems like there's still a lot of inflationary pressure if the Fed's only going to taper about $15 billion a month. So it seems like it would still be, the Fed's actions would still be pretty bullish for gold and silver.
Yeah, in the long term, they will. So this is a short-term market reaction to what's going on. I don't think it's going to affect gold and silver in the long term. What will affect gold and silver in the long term is that the Fed completely stops quantitative easing and begins to raise interest rates towards 5 to 6%. The reason I say 5 to 6% is the IMF and the BIS have done studies that show during a typical recession, the central bank needs to 5 to 6% of interest rates to cut to start to alleviate that recession. We're sitting just over zero here in the United States with our central bank, the Fed. So if they say we're going to completely stop buying bonds and we're going to raise interest rates toward a 5 to 6% goal, then I think you would see normal behavior, return to markets. And anything along, from where we are now to that goal would be extremely bullish for gold and silver. In this environment, they're really making little baby step changes. So I don't expect it really to affect gold or silver that much. You're going to, the effects on gold and silver would be transitory, as they say.
Yeah, very much transitory effects. I think that's great. And one of the things that you mentioned is how, the Fed would have to reduce interest rates by about 5% if we went into another recession, but they don't have that ability. So what kind of, it seems like then the Fed is trapped if we have another economic downturn.
The Fed is in what you call like a classic bull trap. So they can't ease anymore, really, without causing more inflation. I mean, the inflation came about, Elijah, because they dropped so much money on the economy last year during the pandemic, 40% of M1 ever created since 1913 in 1 year, that not only did it boost up asset prices, paper asset prices like real estate and stocks, it actually found its way into the economy, into commodities prices, producer prices, and then eventually into, through the supply chain to the end consumer. And so if they continue that, inflation is going to rage, and it's already more than 2 times their stated policy level. So the Fed has to not continue its easy money policies too much, or you could talk about runaway inflation, and they don't want that. It's dangerous to them. On the other hand, if they taper too much at a time or raise interest rates too aggressively, it can start what we saw in quarter 4 2018, which was a 20% retraction in the stock market. And that could panic the market, of course, which would be bullish for gold and silver, as it was back then as well. So the Fed is really stuck. They can't move too much in either direction. They can only take baby steps.
With respect to all of this, as we're seeing this inflation, we're also seeing people going to the store and buying the goods that they need, and this causing an issue because there's not enough supply. We're seeing the supply chain issues that we've talked about before. But you recently came out with a video explaining kind of some steps that people can take to prepare for even further supply chain issues. What were those?
So we expect further supply chain issues. I took a video of my local Walmart here in Grapevine, Texas, how they took 1/3 of their store floor and basically built a wall around it, and they're pretending it doesn't exist. And I got pictures before they finished the wall. There's nothing there. So they've reduced the local Walmart by 1/3 because they don't have enough supplies. And I asked some of the employees, why are you doing this? Like, we don't have enough stock. Okay, so the Walmart, one of the big daddy retailers and our big box retailers in our area, doesn't have enough stock. So we're seeing real supply chain shortages reach the end consumer in the forms of stores. So one of the things that we recommend people do, number one, determine what is critical to you and that you really need, and then stock up on those items, right? If you have certain medications that you feel are super important, if you're a truck driver and you need extra supplies like oil and tires, things like that you plan for your business or for your everyday life, try to stock up on those ahead of time as much as you can. Two, go to a cash position, increase your cash level, because with supply chain shortages, that means more dollars that the Fed has printed in the last few years, chasing fewer goods. That means we can expect prices to continue to rise, continue to have inflation in the supply chain. That means it's going to cost more to get your goods. So you may need a little bit more cash to meet your monthly budget of items that you already buy. And the second thing is to reduce debt and reduce your impulse buying. Don't buy things that you don't need, and try to reduce your usage of debt as well to remain as liquid as possible, to have flexibility in your budget. And if you do those three things, a lot of times it can help you get through the supply chain crisis. I will say this, I've been talking to some experts on the supply chain recently, including Otavia Costa of Crescat Capital, many people at conferences, many people that work in the supply chain. And they're saying that they think the supply chain problems are going to go longer than the next 1 to 2 years. They think the supply chain problems don't only go to shipping and trucking, but they go to the beginning of the cycle in harvesting, refining, and mining. And until we get more money flowing into those activities and more stuff pulled out of the ground to make goods, we're going to have less available. So people should expect that the supply chain shortage problem should be there for the next 2 to 3 to 4 years.
No, some people might think this is a bit counterintuitive. You mentioned, and this makes perfect sense to me, is buy the basics, right? If you're buy the things that will rise in price and you'll need anyways, right? That makes perfect sense. But holding cash, it seems like, well, that's just going to be deflated. So why are you suggesting holding cash that will devalue in inflation?
So let me define cash. I'm glad you asked that question. Cash can be, I say use a bucket approach. So cash can be really two things. Cash can be greenbacks, Fed dollars that you can use to buy stuff on a monthly basis. And you need a little bit more of that to meet your monthly budget, because you're going to have more dollars bidding up lesser goods. You're just going to have more cash on a monthly basis. So keep 30 to 60 days of cash on hand to buy supplies, so that if you see a shortage coming in something, you can get in there and get what you need. And also just expect to pay more for bread and milk and eggs and those types of things. And the second thing that can be cash or gold and silver bullion, because honestly, Elijah, I just went to my local coin dealer and redeemed some old coins I bought. It took me about 45 minutes and I had cash in hand. So gold and silver bullion, common dated coins, non-numismatics, things like that can be instant cash. When you go to your local coin dealer, you can sell on eBay or whatever the case may be. So you can use some of your gold and silver as cash as well. And so those are the two buckets that I would increase allocations to, as anything very liquid asset. One other thing that I did for our private subscribers and supporters on Patreon is I gave another bucket, which is considering some of your longer term investments like a 401k, a pension fund, real estate as potentially a liquid asset. Meaning, if you had to, know what the provisions are that you can take a loan on your long-term stock holdings, take a loan against your real estate, or maybe even downsize your real estate if you're worried about being able to afford your house. These are more drastic changes that people should consult with their financial advisor for, but those are potential things that you should begin looking at. Read your policy documents on things and understand what your options are for potentially liquidating or monetizing some of your longer-term assets as well. Because if the supply chain issues get really bad, you're going to have to look at all options in order to be able to survive on a monthly basis.
Can you share with our viewers some of the fundamental reasons we're seeing these supply chain issues? We saw the COVID pandemic and the shutdowns because of that, and that makes sense, but why would we continue to see them as things are starting to open up again?
So what happens when you do a push button stop of the economy and then a push button restart? You hit the Staples easy button and you restart and everything should be good, right? Well, along the way for about that year to about 15 months when things had shut down, a lot of things happened in the supply chain. One, we had supply destruction of basic materials. A lot of mines shut down, a lot of harvesting shut down. People were put out of work. And now we're demanding that again, and there's not enough supply. A typical mine takes 5 to 7 years to go from exploration to production. Even if you have a mine on care and maintenance and you're bringing it back, sometimes you have to go to the government and say, we're restarting this mine. We need to go through an approval process. So there are regulatory and or physical limitations to just restarting at the beginning of the supply chain, getting more core material goods that we use in our products. Along the way as well, we had a destruction of things like people willing to drive trucks and run cranes at ports, and we had a destruction of making containers. So now there's all this pent-up demand which comes in when you had supply destruction of all the goods, services, and even labor needed to run the supply chain, and all of a sudden we're having to rush to catch up. And right now, what we're also seeing, a report I saw specific to truck driving, older truck drivers are retiring. The millennials are not coming into truck driving because there's a specific narrative put forth by the media, which is the automated driving, like think Tesla, is coming to the trucking industry to where we won't need truck drivers. The experts tell me that is about 10 to 12 years out. It's not happening right now. But because millennials don't see a long-term career in truck driving, they're not becoming truck drivers. So we're not replacing the truck drivers that are retiring, plus the additional truck drivers we need as the economy expands. So you're having a lack of labor in certain areas of the supply chain that's going to cause companies to have to pay more. They're going to have to raise their rates. Tons of articles out in the mainstream press about restaurants having to pay people $18 to make pizzas because that's what it takes to get them in the door. Same thing with truck drivers. The rates are going to have to go up. So some of this will be alleviated over time as wage rates increase. But remember, that also puts pressure on the business's bottom line. And you can only do so much wage rate increases before businesses have to start cutting back. So it's going to be this tightrope that we're walking as we try to address all the issues in the supply chain for the economy. And I don't think it's an easy problem to solve. I think it's going to take quite a bit of time and maybe even some attention by our local and federal governments.
Well, Robert, we really appreciate your time today. Before we let you go, did you want to share with the viewers any last thoughts you had and where viewers can find you online?
Yeah, I do think stay bullish on the gold and silver. Short-term news like this doesn't really affect gold and silver long-term. It's a buying entry point. I always say that gold and silver are down today. If you're a gold and silver investor, perfect time to buy more, perfect time to buy more mining stocks if you're into that. If you want to reach us, just hit YouTube Gold Silver Pros or goldsilverpros.com on our webpage.
All right. Once again, Robert, thank you so much for your time and God bless.
Thank you so much, Elijah.
This is Dunnigan Kaiser, founder of Liberty and Finance. I'm now a licensed gold and silver broker for Miles Franklin. Call me directly for the physical gold and silver that you need at the best price with personalized private service from one of the oldest and best companies in the business. 31 years strong, A+ rated by the Better Business Bureau, 0 complaints, licensed and bonded. For physical delivery, vault storage, or precious metals IRAs, excellent prices, privacy, and confidentiality. Pay by check, money order, ACH, bank wire, or Bitcoin. Satisfaction guaranteed. For fastest service, just call 1-888-81-LIBERTY. That's 888-81-LIBERTY. And either I or one of my sons and fellow brokers will call you back as soon as we can and understand your needs.